Mortgage rates have come down, and with the Fed rate cut, it's possible that continues to happen. So here's the question I've been getting. You may be thinking, is it time to refinance my mortgage? How do I know? Got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. So the markets typically are going to move ahead of an interest rate decision or an announcement by the Fed. That's why the dot plot is so important, or what the Fed says and how they're posturing is so important, because the Fed, when they're making interest rate decisions, they're influencing the overnight lending rate, the Fed funds rate, and the rest of the interest rate yield curve. But the other interest rates are supposed to be moving in sort of in the free market and sort of free from intervention or tampering. Now, it's not 100% true. It's not altruistic. But mortgage rates, take a look at this chart, after peaking, about a year or so ago, have been coming down, even before the Fed made their announcement. And what's interesting is oftentimes mortgage rates are connected to or might move closely with the 10-year Treasury. And we've seen since the Fed announcement, the 50 basis point rate cut, the 10-year Treasury's actually moved up. And so it's very possible mortgage rates won't continue to fall the way we've seen them do so here, but gosh, what a welcome relief here. So here's the question. Is it time to refinance your mortgage? If you bought a house or if you got a mortgage within the past couple of years, is it time to refinance? I had a client reach out to me and say, they bought their house this summer. They'd been waiting, had been looking to move, and finally they said, we found the house and we know interest rates are high, but we're going to move. And so their mortgage was at 6.5%, so far better than 7.5%, or close to 8% that some of you are experiencing. But when they were signing the documents, when they were getting the mortgage in place, their lender said, okay, yep, and then you'll come back and see me in the spring, we'll refinance then, and plan on refinancing the year after that as well. Now, I thought that was aggressive. You got to be careful of just that assumption, number one, because if you really can't afford that mortgage and you're just relying on, well, I can probably keep the belt tight for a couple of months, but I'm really going to be waiting on that refinance for this to actually fit. You don't want to take that much risk. But the other thing is you need to be careful because these loan officers, these loan originators, there's a loan origination fee. They make money when they refinance a mortgage or when they create a mortgage, and they don't service it. So they, the mortgage is then serviced by a different department, even maybe a different bank, different financial institution. And so they might have quotas to hit, or they might just be trying to make money. And so therefore, no matter what the situation, if rates are down a little bit, they might say, okay, time to refinance, even though it may not be in your best interest. So you got to be cautious and got to be wary of that. So how do you know? How do you know if it's time to refinance? Well, you shouldn't run your finances off rules of thumb, but when it comes to mortgage refinances, that's where a couple of rules of thumb can really be beneficial. This is no substitute of getting individual advice, working with your certified financial planner to do the math. I'll get to that in a second. But at least starting with rules of thumb can help you know, all right, well, is it possibly time to refinance or not? The first is a 1% reduction in your interest rate, a 1% reduction in your interest rate. And I actually fear this has been sort of common rule of thumb in the financial world for decades and decades. But I actually think because we saw interest rates, mortgage rates go way up in the refinance business, the refinance market, and all these folks working in that industry, it just collapsed. It just stopped. It ground to a complete halt. Loan originations, with so few homes selling and basically no refinances, it just dried up. I am concerned that now even a 0.5% reduction in interest rate or whatever is going to have those folks really hungry saying, you should refinance because you'll get a lower rate. No, it's how much lower? Rule of thumb, 1%. That doesn't apply in every single circumstance, but that's the starting point. That's the rule of thumb. But then it's not just a 1% reduction. It's 1% and that you're going to have that mortgage for at least 3 years. Again, doesn't apply in every single situation, but as a rule of thumb, that you're going to have that mortgage for at least 3 years. And what I mean by have that mortgage, that you're probably not going to refinance again in the short term, and that you're not going to move likely within that 3-year time period or within a short term. So why do I say that? Why even have those rules of thumb or that guardrails? If I can get a lower interest rate, I should get a lower interest rate, right? Because it costs money. It costs money to refinance. And typically, when you're just starting a loan, the majority of your first payments, and not first payments like first couple, although that's true, but like for the first few years, most of it's going towards interest and very little is going towards principal. So what we saw as rates were coming down, a decade or so ago, is people had a 5% mortgage, and then when they refinanced to a 4% mortgage, their balance actually went up. Because of the closing cost, because of the cost to do a refinance, they didn't have that money out of pocket, so they added that on to their loan balance, and they hadn't even paid down enough principal so that when those loan origination fees and those closing costs were added on to their prior mortgage balance, they actually now had a higher balance and lower interest rate, but higher balance. So it's those costs that you need to watch out for. And I don't know, you guys, I'm old, so I would have said, the closing costs typically are made up of two things. You've got all of your fees, and that would be title fees and loan origination fees and all that sort of stuff. And then you have your prepaid items, establishing your escrow account and pre-funding it with some dollars so that property taxes when those come due and homeowners insurance when it comes due, there's some seed money there. So I'm not talking about the prepaid items, right? That's going to be the same whether you keep your mortgage or refinance. But the actual true costs, I would have said, it should be around $1,500. Guys, that's old. I think the average now, or at least from what I'm seeing experientially, $2,500, $3,000. Typical closing costs, and obviously that depends. Some banks will charge a higher interest rate and say no closing costs. Haven't seen a lot of those recently, but trust me guys, those are coming back. So you need to be aware of those costs. Now, work with your certified financial planner. Those are some rule of thumbs to get you started and maybe help you be aware of loan sharks out there, loan predators. But you'd still need to do the math with your certified financial planner, and you got to take a look. I ran some numbers here before the video, and a $300,000 loan for 30 years at 7%, at a 7% interest rate, approximately you're going to pay $21,000 in interest in that first year. Oh gosh, that is painful. It's approximate. Now at 6%, everything else equal, $300,000 loan, 30 years at 6%, you're going to pay about $18,000 in interest in that first year. And so the delta, that difference, gosh, that's saving you money. That's a great thing. Not just that your payment is a little bit lower, but you're actually paying less in interest. But again, that interest reduction is going to come at a cost. So you want to be aware of what makes sense financially for your situation. So work with your certified financial planner on that. If you do happen to have a higher interest rate mortgage, this is great news. We all expected that rates would be coming down. No one knew exactly when. Right now, they're close to 6. I heard a rumor on social media recently that someone had one in the low 5s and even one that started with a 4. Just depends on your situation. So hopefully those rates continue to come down. It's possible you may refinance twice over this interest rate reduction time period, but you want to do so through wisdom, looking at your financial situation and making a wise choice for your specific situation, all 6 areas of your financial life. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.